Hello and welcome to Chapter 21. In Chapter 21, we're going to talk specifically about variable costing. We're going to compare and contrast variable costing to absorption costing. Learning objectives, we're going to distinguish between variable and absorption costing. We're going to compute operating income using variable and absorption costing. And I'm going to do this a little bit more skinny down or a little bit more narrow than what you might have seen in some of these PowerPoint slides. I'm not so concerned about the differences in operating income with each iteration of variable and absorption costing, but we're going to touch on that just a little bit. There's going to be a lot less information here than what you might see in your text. I don't want to focus a lot on that, but it will be there. We're going to look at variable costing to make management decisions for a manufacturing business, and the same for a service business. So here we go. Distinguishing between variable costing and absorption costing. Sometimes managerial accountants and companies want to look at variable costing specifically for internal to the business. So it's only going to look at variable costs and not all product costs. So you can look at the difference down here. Absorption costing has all product costs, which includes fixed costs, whereas variable costing only looks at variable manufacturing costs. And you can extend that as well to a service company where they extend those types of things for variable costing for a service business. So you can take a look here, for example, at this table on the absorption costing, which is typically what you're going to see for external reporting for publicly traded companies. You can have direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. You notice over here, you don't see anything for variable costing. The next thing you notice is in absorption costing, variable selling and fixed selling are considered period costs, and fixed manufacturing cost overhead are considered period costs for variable costing. What that really boils down to is that these product costs, what's going to happen is you're going to put some fixed manufacturing overhead as part of your inventory in the absorption costing model. And in the variable costing model, you will not. In traditional format, here's what you're going to see. External reporting, internal reporting is going to be in a contribution format, which is something you're very familiar with after we've been through the CDP stuff in the last couple of chapters. So you notice the difference, but you notice the difference here. You're going to have fixed cost, which is actually going to be fixed manufacturing overhead and fixed selling cost. And in fact, this variable cost here really represents variable selling, variable manufacturing, variable manufacturing overhead, direct labor, and direct materials. So all of those are included. So let's look at just some simple examples as far as unit costs and how you would look at them differently. Tells you that there was 2,000 units produced. The selling price was 500. The direct materials, direct labor, and variable manufacturing overhead are all on a per tablet basis. And then you have fixed manufacturing overhead. Notice the big dollar amount. That tells you it's per year. And down here the same. So if you see per tablet, pretty much you're going to know that those are variable costs. And the big dollar amounts are going to tell you that those are fixed costs. So let's look at a comparison. If we look at the costing of the two, absorption costing includes all the variable manufacturing components plus fixed manufacturing overhead, which we saw already. And we're taking 110,000 units divided by $110,000 divided by 2,000 units, which gives you $55. So fully absorbed cost, and you can do this in either to allocate these costs, these overhead costs, you can do it either using ABC costing or just a traditional costing method is $55. So it's $300 for an absorption costing, and variable costing is only $245. But remember, this whole 110,000, and we'll see this here in a minute, this whole 110,000 is actually going to go as part of fixed cost in the variable absorption model, and it's going to be considered period cost. But for absorption costing, it's going to be considered only the portion that gets sold in a given period is going to be expensed. The remainder of it is going to go into inventory. So if they produced 2,000 units and they only sold 1,500, then 500 units of that cost, or 500 times $55 plus all this other stuff, is going to be contained on the inventory section of the balance sheet of the company. So let's look at the operating income. This is the section where I've skinnied down the slides, and I'm just going to go through each slide and not in a great lot of detail. I just want you to get exposed to this a little bit and the impact of using variable versus absorption costing for a business. And so you have an idea. It's not perfect, but I just want to give you a perspective. So here's what it's looking at, what we want to look at. Variable costing and absorption costing, what are the results as the income as depending upon the number of units? In other words, units produced are more than units sold, units produced are less than units sold. What is the operating income results? So let's look at this first one. I'm just going to have these slides. So how does operating income differ between the two? Well, what's going to happen is all this stuff kind of remains the same. You notice the difference here? You're going to take cost of goods sold, but it's only going to be a portion. This red one's going to, it's only going to be a portion for the units that you sold, not was produced. But here, you notice it doesn't matter because these are fixed costs. And remember, we saw this earlier. These were considered period cost in a variable costing absorption model. Here, these are product costs. And so a portion of these costs are going to get capitalized or put in the inventory on the balance sheet. And there's a difference here as well. But I think the big thing you want to look at is all of the fixed manufacturing overhead costs get expensed under variable costing where only a portion does here. The variable selling is going to be the same, even though it's in a different category, it's going to be the same. And the fixed selling is expensed all for both in both models. So let's look at the numbers for a minute. So this one is production equals sales. When production equals sales, there is no difference whatsoever, right? But what you're doing is you have the variable cost and you're picking up all of the fixed manufacturing cost. And remember, we knew it was $110 per unit. And $110 per unit, part of that 110 was the $55 we saw earlier is buried in this $300 per unit. If we go back to, let me see, where was it? Maybe even one more right here. See this 300? That's the $55. I want you to see that. So all of that is expensed. All that is expensed here, and it's part of the 300. And it's all of it is expensed here as part of the 110. So if you take 200 times 55, 110,000 of the 600 is fixed manufacturing overhead equal. So there is no difference if you produce exactly what you sell, right? But now let's look at it this way. Let's say there's no beginning inventory and there's no ending inventory. Well, this is what it says. This is a summary of what we just talked about. But the next one, here's the next one. Now it says production equals sales. We just went through this. Let's go to the next one. Sorry. Production exceeds sales. So now what happens here? We produced 2,000 units and we sold 2,000 units, but you notice here it's only 289 here, and you have all of the fixed cost is not spent out. I think there's an error in this because you there's an error in the way this is presented. But you see what's happening here is you have 1,500 units that are going to be contained on the balance sheet. And this is after year 3. So I've spent enough on those slides. My apologies. I just don't think they're value added for our discussion. The point I'm trying to make, though, is the difference between variable and absorption costing is that in absorption costing, you put a portion of your fixed manufacturing overhead on the balance sheet to the extent that you have inventory or you've produced more than what you've sold, or vice versa. That's what I really want you to know out of all of that discussion. And typically, most of you guys are going to work for, if you work for a publicly traded company, they're going to use absorption costing. So that's the model you will see. The variable costing is going to look different, and it's really for analytical purposes within the business. And that's what we're going to focus in on this particular section. So how do they use these for making decisions? One of those is for establishing selling prices. Another is for controlling costs. And the third one is for production planning to determine where they're going to make stuff. So each one of those are different. So they want to analyze profitability, and they want to look at which products are they going to sell, because they want to look at contribution margin and sales mix and profitability of their business. That's a big, big deal, obviously. So let's look at the example they give us in this presentation. It says we have units sold standard and premium. And if you notice, what you have is it gives you a sales price of 500, the variable manufacturing cost of 245. Here it's 600 and 360, and the sales commission is 10%. So we can tell here already that our variable selling cost is going to be 270 and our contribution margin is going to be 230, and our variable cost here is going to be 420, and our contribution margin is going to be 180. So this one's going to be a 30% contribution margin, and this one's going to be significantly higher. It's going to be, we'll look at it here in a minute. So you can look here. So here's the contribution margin by income statement: 1,200 units, 1,200 units, 2,500 units. And you can see the variable manufacturing cost for this business. And it says that their total contribution margin ratio is 42:31. But you have to really look a little bit more at the details of what happened for each one of these, right? Because you can't just look at this number. You have to look at these ratios for each individual. And you notice what happened here. They had the same ratio, but they have their sales units are different, right? So you have 92%, Gary sold 92% standard and 8% premium for his total 1250, right? And Selena sold 850 standard and 400 premium. But you notice that their mix is different. And the driver, the contribution margin difference is really the sales mix between the customer, between the company, okay? And so you'd say, well, which one is better? Ideally you would want to sell more standard because their contribution margin is larger. And as the percentage goes up, the overall contribution margin of the business makes a difference, particularly when you have scarce resources, as we talked about in the last chapter. So what are we doing? We're looking at this contribution margin. Here's another example. Period one and period two, 38% contribution margin in period one, 32% in period two. Well, let's break it down, period one and period two, and see what happens. You have, it appears that both the variable manufacturing costs and the sales commissions are higher in period two than they are in period one. So an organization wants to take a look at what's driving them on a per unit basis, because obviously something has happened where both of these things have gone up. And you notice that the selling price has also gone up. So even though the selling price has gone up, they must be selling a higher quality of product than what they were selling before. And it's costing them money because you notice the contribution margin went down. That's a little bit different analysis that you would do for contribution margin. But here's what happens when you want to take a look at these particular models and how you want to, what you use these for, and what's the decision. In the long run, absorption costing, you must cover all of your costs. In the short run, you're only going to look at a variable cost as your relevant cost. Same thing holds true for each of these. All in the long run, really you want to look at absorption costing. But in these short run profitability things, you want to look predominantly at variable cost. Are you making money on what you are selling? The fourth and final objective, using variable cost to make management decisions for a service business. It has the same exact character. The only difference is you don't have any inventory or cost of goods sold. Variable costing can be used by services or service companies, and they have both fixed and variable components. So here's kind of the same thing, but you really don't have this whole contribution margin. You have a contribution margin still, but it's a little bit different, and it's only a service company. Notice there's no manufacturing costs, it's just expenses. So this is a towing company. And then you can kind of take a look at the different types of jobs and what their contribution margin is and what their variable cost is associated with each. And you notice that they make a whole lot more money doing jobs for the city than they do for a county. And you could analyze that and determine why. And what you might find out is they drive a whole lot more miles for the county and they don't charge a straight fee. Maybe for the city, they charge a minimum of, say, $90 to pick up a vehicle and so much per mile. Well, they might not be able to get that same ratio. So it might be a driving thing based off of the pricing, or it might be more competitive in the county than it is in the city. You don't know. You have to look at the business and what the drivers are for that particular business. And here's a contribution margin analysis, and it kind of gives you the same sort of stuff, but you have to go one level lower to understand what is happening. Because you notice here, the truck expense is higher, and also the driver expense is higher for the county jobs, but their pricing appears to be off. So they're charging the same price for both. So you don't know what the dynamics of the business are, but you would think that they need to raise the price or maybe control the cost in order to do a better job in the county jobs than what they're doing. You don't really know because the truth is if they targeted a 60% contribution margin, this price should be significantly higher than what it is now. And those are questions that you want to ask as a business in order to determine that why are we charging the same price for the city and the county? Maybe we need to do something different because our cost structure is such that that's what happens. And that's the end of chapter 21. I hope you have a great day, and I look forward to talking to you in chapter 22.